Thank you. Pleasure to be here. See, the NPA there is no big increase actually. So PAR 90 has gone up by 15 bips from Q to Q3. So that's why it's not big. We always told that Q1 and Q2 are not the representative. They are very low at that point of time. It's not a stable quality. Stable quality probably we are in. That is why we always guided 1.6 to 1.8% of credit cost, and we are exactly there. So probably we are in the steady status right now. We don't see increase from here. It's supposed to be within this range as we guided for this financial year. Whereas the asset growth, we grew about about 4% QOQ, and overall we guided about 24-25% growth for the financial year. We are in the same line of growth, and we also assume that about 3 to 4% of our book will be retail by end of this financial year, which is supposed to be 12 to 15% by next 4 to 5 years. We are exactly in the same trajectory, and we believe what we guided, we are exactly on that line of growth at this point of time.
Okay, all right. Hi, Mr. Hebbar. Good morning and good to see you again. So your credit costs you're holding at around 1.6 to 1.8%, AUM growth of mid-20s, and retail as a percentage of your book will gradually move up. We got those data points down. Give us a few more numbers though. What was your cost of borrowing, and is it expected to go up? What does it mean for your NIMs? And given that you're expecting asset quality to improve from here on, you want to give us a number on the gross NPAs, net NPAs, the targeted numbers?
So our cost of borrowing has been stable around 9.7 to 9.8. We don't expect that to go up actually. So we feel from here on it's stable or going down over next 2-3 quarters time. And then liability again is quite strong. We have been able to have a very good flow of liability and very stable liability, so we don't have any challenge on liability side. In terms of NPA, gross NPA, net NPA, we believe it will be within 1% range for the financial year.
Okay, and you said, sir, your NIMs will hover around what? I missed that number. Cost of borrowing will be stable?
It will be between 12.8 to 13 kind of thing.
12.8 to 13. Okay.
What has changed in your borrowing mix? Because I noticed you've also, taken a cut of around 50 basis points across both your microfinance and the retail finance business.
Right.
Is that on account of you wanting to grow your loan book out there? Or is it because your cost of borrowing itself has reduced by that much? How does that impact your yield going forward?
Yeah. There are 3-4 components for the pricing policy. Pricing policy works with the cost of credit, cost of operation, cost of running the company, and cost of finance. There are 4 factors. The cost of borrowing is stable and coming down over a period of time. Whereas our operating cost has come down quite drastically in the last 1 year from 5% to 4.5%. And similarly, credit cost is what we projected both for the period is quite stable. In this kind of thing, on an annual basis, we keep reviewing our pricing policy. In that point of view, at that point of view, we actually ensured that based on the efficiency improvement and the stable financial or stable cost of borrowing outlook, we reduce the price to our customers.
So that does not have any impact on your NIMs, etc. going forward, right?
It will definitely not impact the NIM, because this will take at least 18 to 20 months for that impacting our business. So therefore, we don't see any impact on our NIM, overall NIM, what we guided because of this price cut.
Okay, all right. Tell us about your mix.
Important to be flowing back the efficiency to our customers. That's the philosophy of the company.
Okay. All right, Mr. Hebbar, you also look at diversifying into other states, newer states that have moved into AP, Telangana as well. So your non-core states, how much does it contribute as a percentage of your business, and where is that headed? Point number 1. And point number 2, your cost to income ratio has come sub 30%. Where does this number stabilize at? Because there will be some costs since you're moving into newer geographies as well.
So non-core states already about 30% of our business, and it's growing annually about 4 to 5%. So AP Telangana it's a new state what we entered actually. So we gradually enter district by district. Therefore, there is no too much cost involved in it. Current cost to income of 29.7% is for this quarter, but for a 9-month base about 30.7 or around 31%. So our guidance is around 31 to 32% is our cost to income ratio, which is achievable on a continuous.
All right. And finally, your borrowing mix, you've reduced your borrowing from banks from what, 55% to 50%.
Absolutely.
Where does this number settle going forward?
We always believed a strong liability franchise to run the microfinance book, and we diversified our borrowing beyond India. Actually, almost 22% of our borrowing internationally we raised, also from DFCs in India, as well as from a public market we raised money. So therefore, currently, bank borrowing mix is around 50%. We believe this will be between 50 to 55%, and the balance will be continuously from internationally, as well as from the domestic DFCs and the public debt. So we believe that annually about 5% of non-bank mix will go up from here for at least next 2 years. So with that, probably bank borrowing may move between 45 to 50% in next 1 to 2 years.